Hey there. Interested in joining a startup and considering equity as part of your compensation package? Understanding what are the risks of equity compensation in startups is crucial before you dive in. While equity compensation can be a ticket to substantial financial gain if the startup succeeds, there are significant risks to consider. In this guide, we'll explore these risks so you can make informed decisions about accepting equity from a startup. Risk 1: high failure rate of startups. Startups are known for their innovative ideas and potential for growth, but they also have a high failure rate. According to various studies, a significant percentage of startups don't make it past their first few years. When accepting equity, it's important to understand that there's a chance the company may not succeed and your equity may end up worthless. Before accepting equity, evaluate the startup's business model, market potential, and team to gauge its likelihood of success. Risk 2: illiquidity of stock options. Equity in a startup is often in the form of stock options, which can be illiquid. Unlike publicly traded stocks, you can't easily sell your equity shares to cash out when you want. Liquidity events like an IPO or acquisition are necessary for you to realize the value of your equity. Until such events occur, your equity remains locked up and you might be unable to convert it into cash when needed. Consider your own financial situation and whether you can afford to have your compensation tied up without easy access to funds. Risk 3: potential for dilution. Another risk of equity compensation in startups is dilution. As startups grow, they might need to raise additional capital, which often involves issuing more shares. This process can dilute the ownership percentage of existing shareholders, including employees with equity compensation. Dilution reduces your stake in the company and can affect the potential financial gain from your equity. Understanding the company's funding plans and how they might affect your equity share is crucial before accepting an offer. Risk 4: vesting schedules and cliff dates. Equity compensation usually comes with vesting schedules and cliff dates, meaning you earn your equity over time. A typical vesting schedule might span 4 years with a 1-year cliff, where none of the equity is owned by you until the first year is completed. If you leave the company before your cliff date, you may lose all promised equity. This system encourages employee retention, but it's essential to understand the terms and timelines before committing, especially if you're planning a career move in the near future. Equity compensation in startups can be an exciting opportunity with the potential for high rewards. However, understanding the risks such as the high failure rate of startups, illiquidity, potential for dilution, and vesting schedules is key to making a well-informed decision. Weigh these factors carefully against your financial goals and risk tolerance. By staying informed and evaluating these variables, you can better determine whether equity compensation aligns with your career and financial objectives. Remember, knowledge is power, and understanding what are the risks of equity compensation in startups can pave the way to smarter career choices in the dynamic world of startups.